Okay. So good morning, everyone. Thank you very much for giving me the opportunity to present a bit how CAT models can be used in the context of a changing climate, and especially in how this could help to assess some potential impact of climate change on the insurance industry. Actually, climate change has been a long topic of discussion among our client base, and here I would like to start my presentation by giving you a bit of feedback, what your peers are frequently asking to RMS about questions about climate change. Probably one of the most frequent questions we receive for us is, will the global rise in temperature continue in the future? That's maybe the top one question we have. We have another one which is about what is the RMS view about the connection of climate change with the frequency and severity of relevant perils for the insurance industry? Another question is more about what basically the impact of climate change has been so far for our industry, and basically how this is accounted in RMS models today. And probably the most interesting question in the end is about how basically CAT models can be used to understand or stress test our business for the next few decades or even a longer future. So I just want to make clear, at RMS, we are not expert in climate change, right? This is not our area of expertise. There are many research centers and academics. They are really doing that for decades. Our expertise is really about how to transfer or translate a natural physical process into an insured losses. This is exactly where we can give them some expertise. And from that perspective, I would say probably the last 2 points are the most important. And here in this discussion, I would like really to focus on the last one, which is about how can we use a CAT model to stress test our business. So we have seen that in the first presentation that we need to select the relevant peril where we can do that actually. And if we look at the IPCC reports, there is a different level of confidence in terms of relating climate change and a specific peril, and probably the most confidence we have is about the sea level rise and how this could influence coastal flooding, storm surge typically. So this is typically one model that we could use to stress test the climate change impact for the insurance industry. One candidate. Another candidate could be wildfire. At RMS, we just released a US wildfire model now, and it's clear with the change in precipitation and wind pattern, wildfire risk is likely to increase in the future. Inland flooding is also another candidate because of the change in precipitation pattern and distribution. Then, of course, one of the big concerns for the insurance industry, this is a tropical cyclone hurricane in the US. Here, of course, the signal is a bit less clear because we have some, of course, the sea level, the sea temperature rise may fuel more hurricane in the future, but we have also some counter effect from the sea currents or the ENSO, for example. So the signal, as we have seen in the presentation before, is to have less frequent hurricane, but more intense one. It's a bit the same for extratropical cyclone as what we have in Europe. It's a bit more complex to mimic, or basically to use CAT models to replicate climate change, because we have many other conflicting parameters, I would say. And probably the less obvious to do, the less as a candidate, this is severe convective storm. So many clients are asking me, well, in Europe, with global warming, do I have to forecast more hail events in the future? Actually, this is very difficult to say, because this is a kind of peril that is more influenced by very localized elements, such as local climate or topography, for example. So from that perspective in this presentation, and as we are all in Europe there, I would like really to focus on inland flooding, because this is probably one of the most relevant peril for our industry in Europe. And this is, as I said, also one peril where we have some good confidence in terms of the increase of heavy precipitation in the future. So at RMS, we have actually a model we released over the past couple of years now that is covering the whole of Europe for inland flooding. And this model actually is pretty interesting because it can be used as a tool to assess the impact of climate change on flood insurance risk in Europe. And one of the main features we have in this model is that we start by modeling precipitation, right? We don't start by modeling flood in a river system. We really basically have a precipitation modeling, stochastic event set that is covering the whole of Europe. And this allows us to model any kind of flooding, not only the flooding that happened in the river system, but also the flooding that happened outside the floodplain. About 50 to 60% of the losses in Europe is actually happening outside the floodplain. So it's very important to start with precipitation. And you can see, I just plot that today. We are in Vienna, so that's the correlation in flood risk between Vienna and the rest of Europe, actually. And you see that there is an obvious correlation due to the river system. That's obvious, but also there is a pretty good correlation also or impact from the meteorology, basically the precipitation, right? So that's showing it's very important to start by modeling precipitation. So if you look at how we do flood modeling, we have many components actually we could use as a dials or tuning some parameters to mimic the impact or the mitigation we could have for climate change. So we model physically the complete process of flood, basically from the clouds to the buildings where it damages things on the insurance risk. And all those different elements can actually be tuned to replicate some potential scenarios in the future due to climate change. So if we start precipitation, that's probably one of the most obvious. As I said, we have here 50,000 years of simulation of the precipitation on an hourly basis. So this is typically things we can modify in the model to assess the impact of a changing pattern in precipitation in the future and how this would translate into an insured loss in the end. So that's one first dial in the model, if you want, we could tune. And especially as we model precipitation, we can capture the change in precipitation we have in the winter or this kind of heavy rain we may have in the summer, like flash flood, for example. Another component would be also to understand how we could modify some component of what we call the rainfall runoff. It means that when we have modeled the precipitation, we try then to understand how this water will interact with the surface. So a part of this water will be evapotranspirated. It means the vegetation will push that back down to the sky, up to the skies rather. It means that about 40 to 60% of water in Europe is usually evapotranspirated. A part of this precipitation could be stored in snow and released in one go next spring, especially in mountainous regions like in Austria. And again, so those elements could be also tuned to understand how the risk may evolve if we have more water stored in snow and released in spring in Europe, or if we can, for example, have an impact by having more vegetation to mitigate the flood risk, for example. That's another example of component in the model we could tune. In terms of mitigation, we could also not only model the impact of climate change, so I would say the negative impact for our business, but also basically how the society could react. For example, in this model, we can adjust on-the-fly flood defenses. So we could understand how we could mitigate the climate change risk in the future by adapting our flood defense system in Europe, for example. I will come back in this example in a minute. And finally, of course, we can play around with exposure and damages. It's, of course, obvious we could understand in the future how we could have a change in the distribution of exposure to make our society more resilient, or we can change our basically of our vulnerability to flooding, right? We could, for example, change the building codes and adapt for the next few decades into a changing climate in terms of flood risk. So that's another component there we could also tune in the model. So of course, in 20 minutes, I don't have time to cover all of them, so I just want to focus on two of them. I would say the first is the precipitation component. And the other one will be a bit about flood defense system. But precipitation is probably a very interesting one. We have seen there is actually a pretty clear signal about a change in the pattern of precipitation globally, but also in Europe. And I would say it's not necessarily actually a change in the average precipitation. It's more having actually more extremes in the future. It could be extreme droughts or extreme heavy rain, right? So that's basically typically the way we could force in the model a vision of the future by selecting out of these thousands of events we have in the model, the ones that are more represented or representative, I would say, from the future, and give more weight to them when we run the model. But that's a very simple way to see how we could use the model to stress test a certain scenario in the future. And if we do that, actually we can have very interesting results. So I can give you one example there. This is really doing this kind of scenario by changing the precipitation pattern in Europe. For one of these IPCC scenario, this is, I think this is the RCP 4.5 is a 2-degree increase. And you see, for different countries in Europe, we have the change in precipitation and the relevant change in average annual loss, AAL, right? Both for the winter and the summer. I don't give, it's just a color code, I don't give number for two reasons. The first is that it's, the absolute value is depending really on where you are and the portfolio distribution. And second, it's not actually the main point. The main point here is that there is a complete non-linear relationship between the change in precipitation and the change in losses. What I mean by that is, if you have, for example, a change of 3% of precipitation, you may have a change of 6, 12, or even more % in losses. Why? Because simply modeling flood risk, or basically translating change in precipitation into a loss, is a highly non-linear process. Everything is non-linear almost. You can imagine flood defense performance is a non-linear process, or even the vulnerability is non-linear. If you change by 10 centimeters the flood depth, your loss may just explode, for example. There is no linear relationship between that. So the only way I would say to assess this non-linearity is really to use a CAT model to do this kind of prospect. That's the purpose of this kind of tool. So that's really very interesting. First feature, maybe you have to keep in mind for the discussion later, is this non-linearity, which is very important for our business, because a small change can lead to a small change in the climate could basically lead to a big change in our losses in the end. We can also use the model not only to investigate the average annual loss, but also what happens at longer return periods. So on this graph, you can see that's the change in losses, again, to some change in precipitation for 5, 10, 50, 100, 500 year return period. And you see the red curve is actually the average change. Again, the absolute numbers, 15%, doesn't mean a lot because it depends, again, where you are or your portfolio distribution. What is interesting is to see that in this example, the change is less in the tail than it is at short return period. And if you look a bit deeper in the model why it is the case, it's just because the tail is mostly driven by severe rain events that happen in a very dry world. You may have month of drought and then a severe rain, so the soil is able to basically absorb a large proportion of that water. And this is why actually you may not have as much increase in the tail that you have in shorter return period, for example. So that's another thing to keep in mind. We can investigate this kind of complex interaction as well using a model. And you can also, which is very interesting, assess what is this gray shaded area, which is basically the uncertainty around this kind of simulation. You see it's pretty large, but it's very interesting to also to understand that a model, by its probabilistic nature, can give you also a view into this uncertainty. So that's also very a key output a model can give you. It's realization about many of those different perspectives or of scenarios, basically. I want to answer why we have this bump at 200 years, because I guess otherwise you may ask me, so I already forecasted, you may ask this question. It's a very interesting one, actually. It's just showing that actually most of the cities in Europe, and especially for this run, they are protected around 200 years event. And this is just showing that basically in the future, a 200-year event may be just more frequent, right? And this is showing actually that understanding flood defenses is extremely crucial. And this is a very key element in terms of modeling the impact of climate change on our insured business, right? Insurance business. And this leads actually to my next point, which is about flood defense management. Climate change, we do see that a bit as a flood modeler, I would say, as an input in the model, and this is something that comes from the nature, I would say, right? And we use the model usually traditionally to transfer that risk to the financial market. This is what we call basically the financial resilience. That's the purpose of this insurance. But with this kind of model we have today, we can go a step further by using the model actually to try to understand a bit how we could feed back this information back to the government, back to the authorities. And this is something you mentioned a bit, this kind of interaction now you may need to have to make the society more resilient. And this is, in this case, what we call this physical resilience that gives this kind of equation of total resilience. So traditionally, we use the model to compute a loss. Here, actually, we can use the model to actually feed back to the authorities about how they should invest best money to actually protect the society or basically mitigate the loss we are having in the insurance business. So just to illustrate that, I give you one quick example. That's a cartoon that's showing a bit how it's functioning in the model. Actually, as I said, in our model, we can adjust flood defenses. So we can play around with that, actually. So imagine you have some exposure that is subjected to flood from the river system. Of course, if you have flooding, one reaction from the community would be to create a flood defense system. So they will protect, again, a certain flood extent from the river using a dam, for example. And of course, if in a changing climate you have more flooding, more severe flooding, you may have this dam being overtopped or breached. And basically, the community may decide to invest more money to improve the flood defense at a certain place. The characteristics we have here for river defense is what we call the standard of protection. We said, okay, it's protected for a 200-year event, 100-year event. This is designing a bit what we call the standard of protection. And this is protecting basically against big fluvial flooding event. Of course, once you are completely protected from flood event, you still have flooding coming from rain, from snow, whatever, which is this kind of attritional loss you may have. And in this case, the community or the individual owner can take actions by protecting individual risks. This is what we call property flood resilience there. So in the model, as I said here, we can adjust both of those elements, right? It's on the flight during the computation. Actually, we can adjust both this property flood resilience and the river defense standard of protections. And it's very interesting because you can now run some analysis. It's a graph illustrating that for a real book of business, actually. And you see that's an excellence probability curve or loss frequency curve. You have the probabilities in the y-axis and the loss in the x-axis. And the dashed line, actually, that's the current situation. It's the current flood defense situation we have in this territory where we model that. So we could, for example, in the model, eliminate all protections, all flood protections. That's the red curve. That's kind of worst case scenario. But we could also imagine that based on our current understanding, what if we increase by 50% flood defense system? And we get the light blue curve. While we decide to invest more money to increase by another 50% flood defenses. That's the dark blue curve. And again, what is interesting to see is that you invest more money, but you don't get the same reduction in losses. Again, it's a non-linear process, right? And it's very interesting, actually, to see that to a certain point, there is no value to invest more money in flood defenses because you cannot reduce the losses anymore in a significant value. You still have, by the way, even if we see an infinite flood defense system, I would say very, very high standard, you still have this residual pluvial risk at a certain place. So I hope you understand the point here. It's a work, you were mentioning Floodry, it's a work we do with them officially, I think in the UK. They use our model actually to understand what's the best impact of improving flood defense system, how this could reduce the insured losses in a more optimal way, to have a more informed discussion with authorities, environmental agencies, and government to basically understand where it matters really to protect the goods, and so that we can have a perfect combination between physical defenses and financial defenses from the insurance system. So that's, this kind of discussion now is also being enabled in the context of climate change and the changing climates. So what I would just want to wrap up there, the 3 points you may keep in mind, and maybe we can discuss that during the panel discussion, is first, this non-linearity is the main important thing, right? And probably this is where CAT models can inform you, is retransforming any kind of changes in natural physical parameters due to climate change into a loss. This is the purpose of a CAT model, and this can give you this insights into this non-linearity, which is very important for our business, actually. And also to give you a sense about the uncertainty around those projections, the loss, because it has a big volatility, actually, in the end. And again, the CAT model can provide you insights into that. And as I said, I think CAT model can just go beyond illustrating what's the negative impact of climate change on our business. It can also be used to inform what's the best decision actually to take and how we can best have an improvement in the total society resilience, which is the financial protection and the physical protection. So with that, I hope I matched the 20 minutes and we have the time for discussion during the panel, I think. Thank you very much.